I'm Brian Tugin. This is Markets in a Minute for the week of August 10th. U.S. stocks reached fresh all-time highs last week as Q2 earnings season is slowly winding down. At this point, we've seen a report from more than 95% of S&P 500 companies, with NVIDIA not scheduled to report for a few weeks. Getting into some of the stats, results have been generally strong across the board. We've seen a beat rate of just around 60%, which is a bit below the long-term average, but we saw robust revenue growth of 14% and earnings growth in excess of 20%. That makes Q2 the strongest quarter of growth we've seen since early 2023. One note on these numbers: we're quoting figures compiled from Bloomberg, which uses operating earnings, not GAAP. So that's going to strip out things like one-time investment gains, which had an outsized impact on earnings for companies like Alphabet and Amazon last quarter. Now, moving on to forward guidance, that was a bit mixed. We saw a good deal of companies guide pretty conservatively into the back half of the year, which likely reflects concerns around uncertain Fed policy and geopolitical risks in the Middle East. That's clearly reflected in estimates as we look ahead, with Bloomberg estimating a decline of 7% for earnings in Q3 and a modest gain of just over 3% in Q4. We're actually starting to see some of these concerns materialize into fixed income markets. Although spreads at an index level are still trading near historic tights, we have recently seen an interesting anomaly in the investment grade space. We currently have around $100 billion of US and European investment grade bonds that are currently trading at wider spreads than BB junk curve. One name in particular is Oracle, which has recently gone on an AI spending spree and issued debt to fund their plans. If bond traders are correct in their assessment of these credits, it could mean that we have a wave of downgrades coming, which is much more reflective of a late cycle credit market, not one trading at near record tight spread levels. So this situation will be something to keep an eye on as it evolves. On the economic front, rates continue to be volatile this week, with the 2-year being the most interesting point on the curve. We saw a large move up on Thursday on the back of a report stating that Fed Chair Warsh made a remark that he was open to raising rates in September if inflation firms. Surprisingly, though, that this had little impact on the futures market, which ended the day with a probability of a hike priced at just below 60%, which is actually a bit lower than where we were to start the week. And then just to wrap up with jobs, the non-farm payrolls came in as a huge disappointment on Friday, showing a loss of 23,000 jobs and a negative revision of 103,000 jobs for the prior 2 months. This had an immediate impact on interest rates, sending yields lower across the curve and dropping the probability of a September hike below 50%. However, before anyone gets too excited, the report is a little more interesting when you look under the covers. We did see a slight resurgence in manufacturing and construction jobs, while the biggest losses were seen in the government and hospitality sectors. And the hospitality sector has been under a microscope lately, mainly due to the speculation that gains earlier in the year may have been related to the World Cup hirings, while recent declines may be due to those jobs falling off now that the tournament has ended. That said, though, these results will make the Fed's next rate decision in just over a month that much more difficult. Looking ahead to this week, it's relatively quiet in terms of economic data, but it will be interesting to see if we get any Fed speak around the potential hike in September. And in terms of earnings, it's going to be quieter than it has been, but we do have a few of the AI players reporting, such as Cisco, Applied Materials, and Supermicro. That's going to do it for this week. If you enjoyed the video, hit the like button, share it with a colleague, and don't forget to hit subscribe. Thanks for watching. We'll see you next week.